There is a phenomenal difference between tax planning and tax preparation. I have multiple CPA firms that we work with. I have one firm that does my corporate taxes. I have another firm that does my personal taxes. I'm not recommending that everybody does that. I have reasons for that, but they're both quality, but they both help with tax reporting. It's not something that we do at the Financial Enhancement Group. It's not even a goal. Tax planning is what those CPAs, myself, and the families that we work with do together, and that is collaboration. We talk about strategies and work together so that when they report the taxes, they can tell the best possible story. That requires doing stuff before the end of the year. Our tax planning package goes out to the families that we serve October 1st of this year. I hope you are on that list. Go to yourlifeafterwork.com, get signed up for a Next Steps meeting, sit down with one of our advisors. Take 90 minutes. You'll get things you need to consider today, things you're going to want to consider in the future, and if we choose to partner together, what FEG will do for you, and we'll put it into writing. Understand the impact of tax planning, one of the single greatest advantages you can have to a successful Your Life After Work. Welcome back to Your Retirement Playbook. I'm your host, Joe Clark, and so honored and happy to have you along with us today. Hey, we were talking about, should I tell my parents? And the conversation that I'm getting ready to have is intentional IRA withdrawals. That intentional means taking money out, even, God forbid, you didn't need to use the money. I know. You were told forever that tax deferral was a beautiful thing. That if you simply deferred taxes today while you were in a higher rate, you would retire and you would be at a much lower tax rate. Now, this is one of the things that I have tried to share with people for years and years. We make decisions about our job and about our hobbies all the time. It's a constant change. If I ask a fisher person what they changed in their fishing the last 5 years, it might shock you, but there are new depth finders, there's new equipment, there's new baits they find, new types of reels, new technology. There's all sorts of new stuff. Who would have thunk, right? I still see the cane pole, Lake Tippecanoe, right? Put the little worm on and away you go. But we learn a lot and continue to ask questions about our jobs and about our hobbies. Everything else we tend to put in a box and forget about. In 1980, the top tax rate was 70%. And people asked the question, should I defer taxes? And the answer was yes. Will you retire at a lower tax bracket? And the answer for most of people were yes. Why? Because your pension was much smaller than the amount of money that you got while you were working. And Social Security was a minimal amount of money back in 1980 relative to where it is today. And so the answer was yes under those tax rates. The problem is most people do not understand what tax rates, marginal or effective, even mean. That we just use those words, and our presumption is that nothing has changed, and we've passed down this guidance deliberately that you don't want to take money out of any tax-deferred vehicle until you're forced to do it. And that is a really, really bad strategy without understanding how taxes work. So I don't have a whiteboard in front of me. Even if you're watching this on a YouTube video, I don't have the whiteboard, but I'm going to try to explain it. I want you to think about stairs going upwards. So on your taxes, you have what's called an adjusted gross income. That is your W-2 income, money you made working, anything you have from rentals, Social Security if you're on it, only up to 85% of it is taxable. Your interest, dividends, and capital gains, all of that's added together, and it's going to give you an adjusted gross income number. That is not, ladies and gentlemen, what you pay taxes on, though it is what most people believe you pay taxes on. You have your AGI, that's your starting line. From that, you're going to deduct one of two numbers, your itemized taxes or your standard deduction. The standard deduction is now so high that it's less than 10% of us, they tell me, that actually use itemized deductions. The big three itemized deductions are state taxes. Indiana, if you happen to be here, is a very beneficial state from the tax standpoint. Not perfect, but very beneficial. Number two is your mortgage interest. Many of you, most of you, have your homes paid for if you're listening to the show. And then three are your charitable gifts. So unless the gifts by themselves and the minimal amount of money that you pay in state taxes trump the standard deduction, you will probably take the standard deduction and totally lose the benefit for charitable gifts, what you pay to the state, and what we would call normal itemized taxation. So We want to know what that rate is. You've got your AGI, you've got those two deductions, and then either the standard or the itemized, and then you've got taxable income. And that's the amount of money that you're actually going to pay the IRS. And so now you're going to get on that magical stairs, and that first step up is a 10% bracket. So up to a certain amount, not a lot of money, but up to a certain amount, you, me, your neighbor next door, Warren Buffett, Bill Gates, the president, we are going to pay some taxes at 10%. If you're married, you get a little deeper step. You get to go a little bit higher and still be at the 10% bracket. And then once you cross that line, once your income is higher, you're going to take a step higher. And that next block of money is going to be taxed at 12%. Now, ladies and gentlemen, some people would say, well, that's only a 2% difference. I will tell you that's a 20% difference. Do the math, ladies and gentlemen, and don't think 20% doesn't matter. You went from 10 to 12. That is 20, not 2. 20% increase. By the end of 2025, it's guaranteed to go back to 15% or a 50% increase. So you really want to have this strategy down pat. From there, you go up to the 22% bracket, almost a doubling, ladies and gentlemen. So people will talk about the rate of return that they get in their accounts, or a 5% drop in the market, or a 10% drop in the market, and ignore an extra 10% or 15% that they're paying in taxes. And the reason is you don't have your tax return in front of you all the time, and most people really don't understand how to read it. We get it, we accept the pain, we write the check, we put it in a drawer, we cry, we repeat, and do it again the following year. That is not the strategy at the Financial Enhancement Group, and it's not the one I would recommend for you. So first, understand your tax rate. Second, you've heard me before, you will always hear me. Always know your kids' rates if you can get that out of them, especially if you intend to leave money behind. And if your parents are still living, you want to know what their tax rates are, because you are likely the recipient of their money. Now, there's a couple strategies that I want you to think about. Bracket bumping and the double stack. We'll teach you these inside of the Financial Enhancement Group, but there's an art to these that we've created and used for many years. Remember, I'm a member, one of the founding members of Ed Slott's IRA Master Group. You can find about Ed Slott at irahelp.com. We've been in the program for over 18 years, where we do nothing but study tax planning, not tax reporting. So bracket bumping is first acknowledging the bracket that you are married to. So when I look at those stair steps, it's almost impossible for me not to be not on the first step or the second step, but I'm into the third step. If I retired and separated from service, pretty much regardless of what I did, my income will be at a point that puts me on that third step. Yours may be the third, it may be higher, it may be the second, but whatever one you're committed to being on, and I don't mean committed because that's where you want to be, I mean financially, the amount of money that it takes for you to maintain your standard of living and the resources that you have, you will be on that tax rate, then you need to understand that bracket. You need to understand it well, the limitations. There are no differences between 10 and 12. When you get into the 22% bracket, there is a Medicare, if you're 65 or over, threshold you need to be very well aware of. So when I talk about bracket bumping, I want to touch the top of that bracket. I don't want to go over it. I want to touch it. I want to bump right up to the top of it. In the 22% bracket, if you're in Medicare a period of time, you don't want to bump it all the way. But I want to know what my bracket will be if if Barb and I are still living, and if one of us is gone, what bracket that I'm committed to. So let's think about this. You're an engineer, your wife's a teacher, or vice versa. Got them both ways. But you've got a good, reasonable income that's making $125,000 to $150,000 a year, and you're in the 22% tax bracket while you're working. Your mom and dad, on the other hand, are living on Social Security. They've got money in an IRA, they've got money in a 401k account, and they're not using it because they don't need it. Well, once they start to hit required minimum distributions inside of the IRA, remember, they can make charitable contributions directly out of that IRA as opposed to take the income, especially if they're not itemizing. This is a no-brainer. So you need to understand qualified charitable distributions. And the CPA can talk to them about it, but it's too late. You need to do it before December 31st for it to help them with last year. So make sure you understand the strategy. And people will say, well, Joe, it's not my responsibility. It's mom and dad's money. It's their call. Come on. We would go to Thanksgiving and we'd tell them about the new fishing bait we found. We'd tell them about the new golf club we found. How do you not tell them about one of the greatest tax deductions that was ever created? Right? Especially if they're philanthropic and they've got an IRA and they're making charitable gifts. This is critical. Mom, Dad, are you using the QCD? What? What's that all about? You will be a hero. I'm talking about putting real dollars, greenbacks, mom and dad can fold over, put in purses and billfolds. This will make you the star of the show, right? So anyhow, mom and dad are at a lower bracket and they're not pulling any money out. I see this all the time when families come in for the first time. I got $1 million inside of tax deferred accounts and they're not pulling a dime of it out because they don't understand Roth conversions. They don't understand QCDs, or they don't understand how to bracket bump. So if somebody's 59, already separated from work, or their income is lower than mine, and I'm going to inherit their money, one way or the other, I want them to the tax bracket, bump it, intentionally take money out of the IRA, recognize the taxes today at a lower bracket than what they would pay in the future if one of their spouses died, or that you would pay if you inherited the money. That is bracket bumping. People change their own oil. Cracks me up. I would never do it. I don't fit under the car. That would be one. Yeah, just kidding, I guess. But I have no intentions. I don't know what I'm doing down there. I don't want to get messy, and I'm not doing it to save my own money. So people will tell me sometimes when I talk about the double stack, Joe, it is too much work. And I will ask the question, do you change your own oil? And the answer is, I'm not paying somebody else to change my oil. Well, then for God's sakes, you need to learn to double stack. This is simple. This is the easiest money, easy peasy for people that are in the right situation. And it is a matter of taking your itemized tax deductions that you would have in this year and paying next year's ahead of time in terms of your charitable contributions. So you have a bigger itemized deduction this year. Next year, you have no itemized deductions. Therefore, you take the standard. You get more money back from the IRS, or a bigger credit, if you will, from the standard deduction, more benefit from it. It just makes sense. Does it take a little bit of time? Yes. Does it take a little bit of energy? Yes. Does it take less time and energy than changing your oil? It does, in my opinion, but it's certainly a lot more than $19.99 or whatever they charge for oil changes if you go down the road to get one. These are two strategies, ladies and gentlemen, that have nothing to do with do you buy stocks or bonds, how do you allocate, what's going on in the market. These are simply opportunities to be able to make the most out of your IRA. Pay attention to your kids. If you're going to leave them money, you may not qualify for a Roth IRA. They may be working, have taxable income, which means they qualify for a Roth if they don't make too much money. Why not take money, make a gift to them to put in their IRA? I do it for my kids every year. I think it just makes sense. They don't have the money to save now. It's money they were going to get later on anyhow, and I can make that money tax-free for a long period of time. It's in their name, so 10 years after they're gone in their kids' names, it can still be there if that works out, and I sure hope it does. Call us at 800-928-4001 or go to yourlifeafterwork.com. Look forward to meeting you soon.